You're listening to Smart Metals Radio from the Hard Assets Alliance.
Hello and welcome to the show with me and Duncan in London. Today, coming to us from Darien, Connecticut, my guest is the well-known financial commentator, James Rickards, author of the best-selling Currency Wars and now author of his latest book, The Death of Money. On today's show, we'll be discussing this book, its investment implications, and what the financial world might look like in a decade or two. Hello, Jim.
Hi, Andy. How are you?
Very good. Your new book, The Death of Money, has a very bold title. Can you enlighten us on what this title means specifically?
Well, it is a bold title, but perhaps the subtitle is even more, a little bit more telling in terms of what's in it. The subtitle is The Coming Collapse of the International Monetary System, and that's really what the book is about. Of course, the international monetary system is based on the dollar today. 60% of global reserves are denominated in dollars. There are other important reserve currencies, including the euro and yen and Swiss francs and pound sterling, but the dollar is the so-called 800-pound gorilla. And I suggest that there's a coming collapse or crash in confidence in the dollar. And if the dollar collapses, the entire international monetary system will collapse with it. Now, when I say that, it's really not meant to be a provocative statement, because the international monetary system actually has collapsed 3 times in the past 100 years. It collapsed in 1914, it collapsed again in 1939, and it collapsed in 1971. And each time it collapses, it doesn't mean, it's not the end of the world. It doesn't mean we all go live in caves and eat canned goods. What it means is that the major financial and economic powers have to come together, sit down around the table, and rewrite what they call the rules of the game. And the rules of the game is an interesting phrase. It's not my phrase. It's been around for 100 years. It's the jargon, if you will, or the idiom that experts use to describe the workings of the international monetary system. So in 1914, after that collapse, there was a meeting in Genoa, Italy in 1922 to rewrite the rules of the game. After the 1939 collapse, of course, there was the famous meeting in Bretton Woods, New Hampshire in 1944 to rewrite the rules of the game. And after the 1971 collapse, you had the Smithsonian meeting in 1971 and some subsequent meetings, the Louvre Accord, the Paris Accords, and others, to rewrite the rules of the game the third time. So what I'm saying to readers is this collapse is coming. There's a very sound reason for thinking that. I give the science and the data and the analytics behind it. I don't believe, Andy, in just sort of throwing out dire, categorical statements and expecting people to agree. I might give some dire warnings, but I like to give a lot of analysis behind it. The book has over 300 footnotes, over 30 pages of sources, so plenty for the readers to chew on and kind of make up their own minds, which is what I like. But I explain why the system will collapse, how it will collapse, and then look past that and say, well, what will the new system look like when they rewrite the rules of the game again for the 4th time in 100 years? What will that look like? With that information, investors can position themselves today. They can position portfolios to survive the collapse and also come out in good shape on the other side. So that's really the purpose of the book.
Well, I'm holding the book in my hand right now, and it's a fantastic book. I've read it cover to cover, and I can highly recommend it. In there, you suggest that there are 3 likely scenarios which will happen if and when the dollar does collapse. The first one is that there'll be a new global monetary order based upon the IMF's special drawing rights currency, or SDR. The second one is that there'll be a return of some kind of gold standard in one form or another, whether that's public or private. And the third one is the troubling one, of course, in which you say there might be a societal breakdown and then possibly a reaction to that, a kind of resultant neo-fascist world order. Which of these 3 different outcomes do you think is currently the most likely to occur?
Well, I think the collapse scenario is actually the most likely, although you're right about the 3 that I've described, Andy, but they could sort of come together sequentially. For example, you might have a global liquidity crisis. That, by the way, the next time there is a global liquidity crisis, and one of them is coming, you can see it coming, it's going to be bigger than the Federal Reserve. You go back to 2008, what happened? Well, the banks were failing, Bear Stearns and Lehman and Fannie and Freddie and AIG. There was this sequential collapse. Well, we were days away from the collapse of Morgan Stanley. A few days after that, it would have been Goldman Sachs, and then Citibank, and then Bank of America. All the dominoes were falling. Why didn't they fall? Well, the government intervened. The government truncated the collapse. It's exactly like you have a bunch of dominoes. They're all falling down, but somebody drops a steel plate between 2 dominoes and stops the cascade. So that's what happened. But The problem is you can't do that twice. In other words, the Fed has printed over $3.5 trillion since 2008 to paper over this crisis. And it's not just the money printing. They've also done tens of trillions of dollars of swaps with the European Central Bank. So, I mean, just to illustrate that point, so you're a European bank. Well, the European banks were in trouble. They have a lot of dollar-denominated liabilities, and there was a run on the banks. Well, the ECB can print euros, but they can't print dollars. So where was Europe going to get the dollars to bail out their own banks? Well, the answer is from the Fed. So the ECB printed euros, swapped the euros to the Fed. The Fed printed dollars and gave the ECB dollars. So there was a dollar-euro swap, and then the ECB could take the dollars and bail out their own banks. So there were tens of trillions of those, plus the Fed guaranteed all the money market funds in the United States and all the bank deposits in the United States. So when you add it all up, it wasn't just the $4 trillion of money printing. It was scores of trillions of dollars of financial relief to prevent the panic from going any further. Now, having done that, you can't do it twice. The Fed is insolvent. The Fed, if you took their balance sheet and marked the assets to market, it would wipe out their capital. Their capital is only about $50 billion. They have $4 trillion of assets. They're leveraged 80 to 1. They look like a bad hedge fund. So the point is, when the next financial liquidity panic comes, it's going to be bigger than the Fed. They're not going to be able to take their balance sheet to 8 or 12 or 16 trillion. So where will the liquidity come from to bail out the system? Well, there's only one clean balance sheet left in the world. That's the IMF. By the way, the People's Bank of China has printed more money than the Fed in the last 5 years. And the Bank of England and the Bank of Japan have done likewise. And so all the central banks are tapped out. So you'll have to go to the IMF. The IMF has a printing press. A lot of people don't know this. The Fed has a printing press. They can print dollars. The ECB has a printing press. They can print euros. The IMF can print SDRs, so-called special drawing rights, or SDRs. It's a geeky-sounding technical name, but just think of it as world money that comes out of thin air and that the IMF can print. And that's not an overstatement. That's exactly what it is. They will flood the world with liquidity in the form of these new SDRs, but that'll be the end of the dollar because China and Russia and the BRICS and the G20 all have a voice in the IMF. And they're going to have to agree to this SDR solution because it'll be the only thing left. By the way, the IMF balance sheet's leveraged about 3 to 1 compared to 80 to 1 for the Fed. So the IMF does have some headroom to add liquidity, but it will be in the form of SDRs. Now, that will be the end of the dollar as the global reserve currency. We'll still have dollars, by the way, but it'll be walking around money in the United States. So the dollar will be a local currency in the United States, the same way the Mexican peso or the Turkish lira is a perfectly good local currency. It just won't be the global reserve currency. But here are the problems, and here's where these things connect. That will be extremely inflationary. And so with that kind of inflation, you could get social unrest, you could get collapse. And indeed, if citizens around the world have lost confidence in paper money in dollar form, why would they have confidence in paper money in the form of SDRs? It might only be because they don't understand them, but if they do understand it the way I've just described, they might not have any more confidence in that. And in that case, you may have to go to gold. Central banks may have to go to gold, not because they want to, but because they have to restore confidence. So you could get all three of these things where first you have hyperinflation, borderline collapse, then the IMF SDR solution, and finally, at the end of the day, resort to gold to reestablish confidence. But if they don't go to gold, they may use executive orders and neo-fascist techniques and martial law to just kind of suppress the dissent. So the important part of my analysis, Andy, is not that I know which one of those it's going to be, because I don't know. But I have a strong degree of confidence, a lot of clarity that it will be one of them or some combination of them, because you can see this coming.
Now, do you think then that the Fed should have let all these banks go in 2007, 2008, such as Citigroup, Morgan Stanley, and Goldman Sachs?
Yes, it would have been extremely healthy. Let me describe how that could have been done without ending the financial system, because it doesn't mean, again, that you have just, a complete shambles. What you would do, you'd wake up, and by executive order, you would nationalize Citibank. You would tell the stockholders, sorry, you're wiped out. Your stock is worth zero. You would go to the bondholders and say, you're going to take a haircut. We don't know how much yet. We have to figure it out, but you're not getting 100 cents on the dollar. You might get 70 or 80 cents on the dollar. And, oh, by the way, we'll give you some equity. Then you strip out the bad assets, and there were plenty of them, put them in the government trust for the benefit of taxpayers, and, sell them over 20 years or however long it takes, and then that money goes to the taxpayers. So you wipe out equity, you haircut the bonds, You strip out the bad assets for the benefit of taxpayers, and then what are you left with? You're left with a clean bank, a clean, healthy, well-capitalized bank. Oh, by the way, fire management knows you don't fire, put in jail because of the criminality around all this. So you send a message. You punish those who deserve to be punished, which are the stockholders and the bondholders. You protect those who should be protected, such as the depositors. You say that, all the counterparty agreements, we're going to honor all of those, so we don't need a financial panic that way. And then you re-IPO it as a clean bank and do it to all the banks. Now, why was that not done? I mean, it's a very straightforward solution. It's been done in Sweden. It's not that different from what we did in the United States in the S&L crisis in the 1980s. All those banks were eliminated, and it wasn't the end of the world. So why was that not done this time? The reason is cronyism, because all the guys in the Treasury and the guys at the Fed and the guys at the banks, they're all buddies, and they didn't want to wipe each other out. They didn't want to put each other in jail. They didn't want to, hurt the bondholders. So it was cronyism at its worst. But what did we get? What we got is Japan. The United States is now Japan. Japan had the same problem in 1990, and instead of closing the banks and wiping out the assets, they preserved everything in amber, and now the U.S. is doing the same thing. So it's no surprise that our growth is dismal. The United States has become Japan because we propped up a crony system.
With a lot of zombie banks. If only we'd cleaned it up then, we'd be out of it now, probably. Now, in the book, you mentioned various prices for gold in the future if we do move to a kind of gold-backed SDR or some other kind of gold standard. You mentioned $7,000 in some places and $9,000 in other places. What do you think under a gold standard would be the lowest price for gold, and what do you think might be the highest value of gold in a post-collapse gold-based system?
Right. The lowest value would be, somewhere between $7,000 and $9,000 an ounce. The highest value could be $50,000 an ounce. So let me explain where I get those numbers, Andy, because I'll mention something like that, in an interview like this or, on television or whatever, and people roll their eyes and they go, oh, that's just some crazy number he made up to grab attention or get a headline or whatever. And it's not true. It's actually based on very rigorous math, and it's simple math. It's not complex. Well, all you do is you just take the amount of physical gold and the amount of paper money and divide one by the other to get an applied price. Now, this is what it would take to restore a gold standard. You have to answer a couple of questions, because every gold standard is simply a relationship between paper money and gold. I mean, we're not going to walk around with gold bars in the trunks of our cars. We're still going to have paper money. The question is it backed by gold, and is it a secure store of value, and can you have confidence in it? So, but you have to answer a few questions. First of all, what's your definition of money? Do you want to use M0, M1, M2? Because those are all very different amounts. How much gold backing do you want? Do you want 20%, which is what the Bank of England had in the 19th century? Do you want 40%, which is what the Fed had up until 1968? Do you want 100%, which I think some of the Austrians would call for? I don't think that's necessary, but there are a lot of economists out there who would say you do. Well, whatever it is, you have to decide it. And then the third thing you have to decide is who's in the club. Is it just the United States or just the Eurozone, or is it basically the entire world? I would argue it has to be the entire world, because if you had some countries in, some countries not, then nobody would want the currencies not backed by gold, so you could kind of eliminate those, which would be deflationary, which would be a mistake. So those are your variables. Define your money supply, decide what percentage backing you want, and decide who's included. Now, once you've decided those three things, then you have to do the math. So if you took, let's just say, the United States, the Eurozone, and China, just those three, took their M1 and backed it with 40% gold. So those are your inputs. M1, three major economic zones, 40% gold. That price today is about $9,000 an ounce. But if you took M2, which is a bigger number, so it's a bigger pile of paper, included the banks and backed it 100% with gold, which I don't recommend, I don't think is necessary, but if you did, that number is about $50,000 an ounce. So these numbers I'm getting at, like I say, they are derived from hard data. They're not made up. But let me explain why they're important. One of the objections to a gold standard, you hear it over and over, is we can't have a gold standard because there's not enough gold. There's not enough gold to support world trade and world finance and the banking system, so we can never have it. That's nonsense. There's always enough gold. It's just a question of price. If you price it too low, there's not enough gold. If you were to go back to a gold standard today at the current market price of about $1,300 an ounce, well, that would be extremely deflationary, because given the amount of gold, if the money supply was 1,300 an ounce times the amount of gold, it wouldn't be that much money relative to the global economy today, and that would be extremely deflationary and would cause a depression. So then the question is, all right, what is the implied non-deflationary price? What is the price of gold so that given the gold supply, we'd have enough money to support world commerce the way it is? Well, that number is $9,000 based on the input I gave you. So, like I say, it's not a made-up number. It comes out of hard data, but it answers a hard question, which is what's the non-deflationary price? Because this is what caused the Great Depression. When countries went back on the gold standard in the 1920s, it wasn't gold that was the problem. They got the price wrong. Churchill insisted on going back at the pre-World War I price. After England had doubled the money supply to fight World War I, that was a major blunder, and Churchill later admitted it. That if they had gone back to gold at a higher price at the time, instead of the equivalent of $20 an ounce, if they had done, say, $50 an ounce, we might have avoided the Great Depression. So you don't have to have a gold standard, but if you do, you better get the price right. And getting the price right means at least, say, $7,000 to $9,000 an ounce.
Okay, given that you're right and that we are going down one of these three paths or all of them together, what's the best way our listeners can best prepare themselves for these scenarios starting right now?
Well, one thing I recommend, Andy, is that investors put at least 10% of their investable assets in physical gold, not gold derivatives, not gold ETFs, not gold contracts with bullion banks, but physical gold. And that acts as I've got the fundamental case for much higher gold prices, which I just described. There's also a very strong technical case having to do with the fact that China is acquiring gold hand over fist. By the way, China sees everything I've just described to you, we're talking about for the listeners. China understands all this. They understand how vulnerable they are to a dollar collapse or dollar inflation. China is the biggest single creditor of the United States. So they're more concerned about the dollar than anyone because they have almost $4 trillion of paper. So what they're trying to do is buy gold to hedge. Now, China does not want the collapse of the dollar. There's a lot of speculation. Oh, they're buying gold to have a gold-backed currency. That's not true. They would actually like a strong dollar. China is they're the world's biggest dollar supporters because they own so much dollar debt. But they're worried that the U.S. is going to devalue the dollar, and they should be worried because the U.S. is trying to do that. And so by acquiring gold, you have a hedge. So you have two paths, right? If the dollar is stable, they might not make very much on their gold, but they'll have the value of all the paper that they've earned. If the dollar is devalued, they'll lose a lot on the paper, but then the price of gold should skyrocket, and they'll make it up on the gold. So by having gold and paper together, you're in a hedge position. If your paper works out, good for you. If it crumbles because of inflation or collapse, you're going to make it up on the gold. Now, take the same thing for the individual investor. If you put 10% in gold, now let's just say that none of these scenarios play out. Obviously, I believe they will because I wouldn't have put them in the book otherwise. But if they don't, maybe your gold goes sideways, maybe it goes down a little bit, but you should be making a lot of money on the rest of your portfolio. But if I'm right and that portfolio collapses because of panic, because of stock market collapses, et cetera, the gold is going to go up, 3, 4, 5, 600%, and that's your insurance against your losses. So if you agree with the fundamental case or even the technical case, you should certainly have gold. But even if you don't agree with those cases, it's a good insurance policy against bad things happening to the rest of your portfolio.
So we've got gold and we've got cash in there. Anything else that people should be looking at?
Well, I recommend fine art, and of course, you see the multi-billionaires going out and spending $100 billion plus to buy a Picasso, and most of us can't afford to do that. But there are some very good art funds out there where, for a couple $100,000 or $1 million, you can be an investor in an art fund where the manager pools that money with other investors, and then uses the pool to buy fine art, and then of course you share in the profits when that's sold. So it's a way to participate in the art market, even if you can't afford to buy a Picasso or a Rembrandt. By the way, not all art funds are created equal. Some of them are better than others in terms of the management. So I think investors have to be discerning and certainly read the documents carefully. But subject to that, I think art's a very good investment. In the United States, when you meet a very wealthy family, maybe they've had the money in the family for 75 years or 100 years, we call that the old money. But when you go to Europe, the old money is not 100 years old. It's 3 or 4, in some cases 500 years old. I was recently in Rome at the Palazzo Colonna, and there's a family that's had money since the 13th century. They've had their money for 800 years, and they're still living in the same house. It's a magnificent house. You know, it actually looks kind of plain on the outside, but just unbelievable art on the inside. But when you talk to people like that, the dynastic wealth in Europe, where you say, gee, you didn't just survive, you know, the Depression or the Panic of 2007. You survived the 30 Years' War, Napoleon, the French wars of religion, World War I. You survived all of it. How did you do that? And they look at you and they say, a third, a third, and a third. And what they mean is 1/3 gold, 1/3 art, 1/3 land. And you have a little cash on the side for your jet or your yacht or whatever. But the example I give is, imagine you're living in Bavaria in 1620 and the 30 Years' War is raging and von Wallenberg is about to, burn down your village. Well, you put your gold in a pouch, you take your art off the wall, roll it up, put it in the backpack, hop on your horse, and ride away. And then you come back a few years later when the dust is settled, you put your art back on the wall, you put your coins on the table, you should be able to reestablish title to your land, and you're wealthy and all your neighbors have been wiped out. So there's an example. That's what I call my 30 Years' War portfolio with gold, land, and fine art, because it will stand up to any kind of catastrophe.
Now, I suspect I know the answer to this because I was at a conference with you where you debated with our friend Roman Skaski about this. But what do you think of Bitcoin as an investment?
Well, I don't think of it as an investment. At most, it might be a speculation. It might, be a form of currency. I'm willing to say that it's sort of functioning as a currency today, but it's an extremely volatile one. You know, the dollar fluctuates against the euro, but that's measured in fractions of a penny, per day. Whereas we see Bitcoin moving, $100 a day, sometimes more. It's traded between $1 per Bitcoin and $1,000 per Bitcoin, in a matter of the last couple of years. So it's extremely volatile. The other thing I don't like about Bitcoin is that it hasn't gone through a business cycle. Bitcoin was invented in 2009. The world's been in an expansion since then, not a very robust one, but it has been growing. We haven't had a financial panic since Bitcoin was invented, so we don't know how Bitcoin will behave in a panic. Whereas, gold and stocks and other things, for better or worse, we've seen how they act. So I don't like the volatility. I don't like the fact that it hasn't been through a business cycle. I don't own them personally. I don't recommend them to clients. One thing I will say is that Bitcoin is not just a currency. It's also a technology, a very good encrypted, open source, distributed, inexpensive technology for transferring title to anything, not just units of value. You can use it to transfer stocks, bonds, land titles, etc. So I think that the future of Bitcoin, the currency Bitcoin may go extinct, but Bitcoin, the technology, may survive because it has all these other useful applications. I kind of analogize it to human DNA. The Neanderthals went extinct, but human DNA survived into modern times. And so maybe Bitcoin, the currency, will fail, but Bitcoin, the technology, will survive.
Okay, well, one last major question. Some of our listeners might be interested in spotting when this collapse might be about to happen. Now, one of the signs in your book is that the gold price is going to start fluctuating quite in a very volatile way and go up in a kind of disorderly, uncontrolled, chaotic way. What other signs can our listeners look out for an impending paper dollar collapse?
Well, that's a very good one, Andy, because, people say, they talk about gold as a commodity, and they say gold went up or gold went down as if it were copper or aluminum or anything else. And I make the point in the book that gold is not a commodity. Gold is money. I understand it trades on commodity markets and all that. I get that. But gold is essentially money. So I think of it as a constant store of value, as what I call the numeraire, or the way you measure other things. That's what a numeraire is. And so when people say that gold went up, I think, well, no, gold didn't change. The dollar went down. Or if people say that gold went down, I say, no, gold didn't change. The dollar went up. In other words, gold and dollar are just the inverse of each other. And so when you see a rapidly rising gold price, don't think to yourself gold's going up. Think to yourself the dollar's going down. The rise in the price of gold is simply the inverse of the collapse of the dollar. So that'll be your best warning sign. The other ones, obviously, are consumer price inflation, bursting of bubbles on stock markets and housing markets. There will be other signs. I think, listeners need to be very attentive to those. And I talk about that in the book. With the way we do intelligence analysis, you don't know what's going to happen. What you do is you set up a range of possibilities. You say, well, here are 3 or 4 things that might happen. But where a lot of analysts fall down is they'll do the 4 things, kind of get that right, and then they'll say, well, this has a 30% probability, and this has a 40% probability, and this has a 10% probability. I think that's nonsense. The way I think about it is one of them has a 100% probability, and the rest are all 0. You just don't know ex ante which one it is. But the way to find out is to set up signs and kind of mileposts or warnings along the way. And a simple example, I live near New York. Well, if you drive your car to Philadelphia, the roadside restaurants are all Burger Kings. And if you drive your car to Boston, the roadside restaurants are all McDonald's. So if you see a McDonald's, you know you're not going to Philadelphia. So by the same token, I have these financial scenarios. They all have different indications and warnings. Watch the signs, watch the warning signs, then you'll know what path you're on. Then you'll know how to protect yourself before the catastrophe comes.
And keep changing the network of your markers. Well, it's been great speaking to you today, Jim, as ever. Is the book actually out yet?
The book is coming out soon. It is available for pre-order now, so anyone who's interested can go to Amazon and pre-order it now. It'll actually be out in the UK and Commonwealth countries and English-speaking countries around the world on April 3rd. It will be out in the United States and Canada on April 8th. So the funny thing is Currency Wars came out in the United States and had to be shipped to England. They actually shipped it on a boat, and it took months to get there, and a lot of readers were disappointed. But that's not a problem this time. We have an export-only edition, and it'll actually be out in the UK before it's out in the U.S. So you can order it, pre-order it on Amazon, and it'll be, as I say, in the bookstores in the UK on April 3rd, U.S. and Canada on April 8th.
I was actually reading a copy of your book outside the Bank of England today, and one of my friends was very jealous about that. Anyway, Jim, thank you very much for your time today.
Thank you, Andy.
Subscribe to the Smart Metals Radio Show on iTunes. You can also visit us online at hardassetsalliance.com/radio, where you can subscribe to our free mailing list and receive our free Smart Metals newsletter. For anyone who wants to set up an account with the Hard Assets Alliance, as a special offer, we shall be waiving opening and setting up fees. Listeners who'd like to speak to a live rep to walk through the registration process can call 1-877-727-7387. That's 1-877-727-7387. I'd like to thank Jim Rickards for joining us on today's show, and I'd like to thank you too for listening. Until next time, goodbye.